All right then. So let's get underway. Please take it away, Jill.
Okay, great. I'm really honored to be here, and we have a cool session on analysts and institutional investors and how can we apply machine learning in this context and what can we learn from it and sort of the big picture questions. So the first paper is on uncovering mutual fund skill with machine learning, and Alan Zhang will be presenting it. Alan, you have 20 minutes.
Okay, great. So can you guys see my screen? And also, can you hear me?
Yeah.
Okay, great. So let me just get started. So first of all, I just want to, thank Paul and all the conference organizers for including this paper and organizing this great conference. And also you may notice that actually I changed my virtual background to be in beach, so I could imagine that I was in Miami. And so this paper is about uncovering mutual fund private information with machine learning, and it was my job market paper. All right, so we know that mutual fund, they filed a semi-annual shareholder report, and this shareholder report is a legal requirement to report portfolio holdings, voting policies, mandatory accounting disclosure, and mutual fund performance. A large part of the shareholder report it's a quantitative information, such as portfolio holdings and performance, which have been long studied by the investors, analysts, and researchers. And in the shareholder report, it usually contains a shareholder letter, which the manager has large degree of freedom to discuss. And so this is just a sample of the word cloud that's taken from the shareholder letters. So we could see that managers, they discuss like economic growth, equity market, bond market, emerging markets, even interest rate. So we could see that there's a large variation in the topics that managers could discuss in these shareholder letters. So therefore, the question that we face is that, since we have such a rich textual discussion, but the information from this textual discussion remain pretty much underexplored. So therefore, in this paper, I just some questions, came into my mind. First, do managers disclose information different on holdings? And what topics do managers discuss more frequently? On the other side, because investors are the target of these shareholder letters. So can investors learn, for example, managers' investment skill from disclosure? And what funds can benefit from disclosing more information? So this paper just tries to tackle all these questions. And that being said, there are several objectives in this paper that I'm trying to achieve. First, and the most important one is to see whether the qualitative information in mutual fund shareholder letters indicates managers' prospect of skill. In other words, do they possess private information that could be converted into superior fund performance? And to achieve this goal, I first define a text-based fund skill measure, which I call textual fund information, using the natural language processing models and neural networks. And then I validate that textual fund information is indeed a measure on managers' information capacity about the fund's future. And then I try to explore the discussion, the contents that are discussed by the funds with textual fund information. So in other words, the more informed funds. And this is because this paper, as the title suggests, is a paper about machine learning. So we would like to see what machine learning contributes to the predictive power of the key variable in this paper. So in other words, I try to open the machine learning black box. And then I identify investors' reactions to the textual fund information, as well as relate the fund characteristics with the propensity to provide informative disclosure. So in other words, what kind of funds are more likely to send more accurate signal to their investors? So this paper, I think it contributes to mainly three strands of literature. First of all, it contributes to literature on mutual fund skill. And I believe this is one of the first study to create a skill measure that is only based on the qualitative data, which is of course distinct from the literature, which they basically use the historical fund returns and fund holdings data. And the paper also contributes to the literature on textual analysis with advanced machine learning techniques. So here I extract the intrinsic linguistic features beyond the meaning of words, and I also train the machine learning model in specific financial context, which is a fund manager's disclosure. And so as I talk about disclosure, so this paper has to be related to disclosure decisions. So I also explore the manager's incentive to signal their skill and the signal on their private information in the cross-section. So there are actually a lot of data involved in this paper. The primary data source is a mutual fund shareholder letters in the form NCSR. So it is an SEC mandatory filing. And because there's no clear cut for the shareholder letter part, so I first use a computer program to pass the filing, and then I spent a lot of manual work, just try to extract the letters from the filings spanning from 2006 to 2018, because these shareholder letters are going to be the input for the machine learning. So I try to make it as accurate as possible. So I actually spent several months to just clean the data. And the fund characteristics are retrieved or constructed from just standard database for mutual fund like CRISP, Thomson Reuters S12. In addition, I construct a link between the series ID, which is a fund identifier in form NCSR, and the WFICN, which is the fund portfolio identifier in words. So in part of the data where I explore the daily flow, the data from trim tabs, I also use the SEC Edgar log file dataset, which tracks the requests and downloads of shareholder letters, by different kinds of investors. And also this paper is related to textual analysis. So, textual measures just based on the Lochner and McDonough dictionaries, which are the conventional approach in this literature. So at the end, my initial sample consists of over 17,000 NCSR filings with the shareholder letters, and they are filed by almost 3,000 domestic active equity funds. And the domestic active equity funds are also the primary sample in this paper. And this is because we have pretty much well-defined benchmark to evaluate their performance. For example, the Fama-French Carhart four-factor model, which is also the primary performance measure that I use in this paper. So here comes the most important measure in this paper, or the key variable in this paper, textual fund information. So basically here I just try to translate the textual data with natural language processing, so that the textual data will be in their numerical form, so that we could use other machine learning techniques to extract more values from them. And specifically, the natural language processing model that I use is called BERT. BERT, in fact, it provides an aggregate numerical representation for each context. And here, for each context, in most cases, it's going to be on the sentence level. So it's pretty advanced, as previous traditional bag of words approach only relies on the meanings of individual words. So in this case, BERT can capture like higher order interactive features among words. So to give it a sense, so just think about two very simple sentences. The first sentence would be, I like research, but I don't like football. The second sentence is that I like football, but I don't like research. So to human, we could see that, well, two easy sentences, and we could tell opposite meanings, right? Because for researchers, we want the first statement. But if we use the traditional bag of words approach, because two sentences have identical words, so it cannot tell the difference between these two sentences. But it's pretty easy for BERT to tell, because the position for the keywords in the example, football and research, their positions are different. So as you could see, this picture shows that, so this is actually the, in a nutshell, that's what BERT can capture. So it can capture the meanings of words, the position of the words, as well as which segment the word is in. And the choice to use BERT was also pretty simple, because when BERT was published, it achieved a state-of-the-art performance on a number of natural language processing understanding tasks. So in other words, it has been the most advanced and most developed model, natural language processing model. So I just took it. And so until here, I did not invent anything. So here it's a little bit more creative part, machine learning part in this paper. However, there are a lot of technical details, behind this part, and at the end of the day, we're all not computer scientists, and we're financial economists. So I'm just trying to give some intuition behind how I construct this variable. I'm also going to use just OLLs to illustrate what I do. And you could see that I believe it's going to be very easy to understand. So the first step is where I use BERT. And so essentially I create a sort of like vector as the aggregate representation for each shareholder letter using BERT. So now all the textual data are becoming just in their numerical form. And I call this vector because if we imagine that it is in the OLS world, in the econometrics 101, where we have the very first equation, very first regression, y equals to x beta. So this vector would be the set of independent variables x, right? And the second part is to create a neural network model. And specifically, because I just want to fit into the specific financial context, I split all the shareholder letters into a training set and a test set. Right? So therefore, the model is going to be trained in the financial context. And in the training set, I compute the fund future performance after like 6 months, after each shareholder letter is filed. So in other words, I have the dependent variable y in the OLS world. And the next, it's just in the training set, I train a model to relate the fund future performance with the shareholder letters. So the idea is to fit an OLS regression to get coefficients beta hat, which is estimation of these parameters. And the last step is to apply these parameters beta hat from the training model and apply it in the test set so that I can get some predictive value on the fund performance for each shareholder letter. So you can imagine that now I have a test set. I use a beta hat from my training set, and I could just generate the prediction on the y, which is y hat. And this y hat is also the predicted performance for each fund and for each shareholder letter. And the textual fund information, this variable is just defined based on this predicted value. So if a fund is predicted to be in the top tercile of fund future performance, then I call them an informed fund. If it's bottom tercile, that's an uninformed fund. And also all the empirical analysis focus on the test set because I don't want to use any like forward-looking information. So in this case, when we only look at the test set, we only use ex-ante textual disclosure, and then we can make a prediction on the ex-post fund performance. So the first task for me is to validate that textual fund information is indeed a measure, on the fund managers' informativeness, which is related to their skill. So the joint hypothesis is that managers disclose qualitative information so that the resulted textual fund information can predict the fund future performance. And my prediction for the hypothesis is that managers who possess valuable private information would outperform in the future because they are informed. They are informed managers who have private information. And the results suggest such a prediction. So we could see that textual fund information is positively associated with fund future performance in the next period, and next period is 180 days, which is also the frequency of the shareholder letter. And across the different specifications, you can see the coefficient on the textual fund information virtually does not change. When I add some textual controls, including the the sentiment in the textual disclosure based on the Locker and McDonald dictionaries, when I add different fixed effects, so the results are all hold. And next, I just, so people frequently have a question, so what contributes to your measure? So therefore, I would like to see how machine learning contributes to the predictive power of the textual fund information. So here I focus on the informed funds. And I also use topic modeling to classify the shareholder letters, using LDA. And specifically, I group them into 4 categories. And the first category, as you could see, I call them to be like sector specialized funds. So they talk about like sector performance. They have well-defined like relative benchmark. And interestingly, many funds actually discuss energy sector. And the second group, they value more about their entire portfolio risk taking. These are pretty cautious funds, and when the market volatility is high, they just try to reduce some risk. And the third group of funds, as we could see, that they talk about like financial, global economy, volatility, and policy. So I call them to be like big picture kind of funds. And so they just want to see overall what's the state of the financial market and the economy. The last group of fund is pretty interesting. Recall that my paper actually focuses on domestic active equity mutual funds. But now you see that many funds, they discuss bonds, yield, and Fed policy, and even interest rate. So it suggests that for more skilled or more informed funds, their skill, the manager skill, go beyond like stock picking ability in the equity market. They can also do well in other markets. So this is also an indicator of why they are more informed funds and why they have private information. And so because nowadays many papers talk about that investors use Morningstar fund ratings to allocate their capital flows, and Morningstar rating is also kind of like industry benchmark to evaluate fund performance and how good the funds are. So here I just want to see whether the tax refund information can predict the Morningstar ratings and the likelihood to receive an upgrade in Morningstar ratings. And the answer to the question is yes. Tax refund information is positively associated with future Morningstar rating, as well as the likelihood to receive an upgrade in fund rating. Right? So you can consider Morningstar rating as just an additional measure on skill, so that we could see that tax refund information can help investors to select the more informed and more skilled funds out of thousands of mutual funds on the market. So therefore, the last part of this paper is to see what are the responses from investors. Can investors recognize tax refund information? So if they do, then informed funds should expect like more flows, especially in the long run when their true skill is more likely to be reviewed. And also to rule out the possibility that investor gets information from other concurrent sources. I examine the daily flows right after the disclosure window using the daily flow data. And another important condition for investor to put their flows into the fund is that, well, they have to read the letters first. If they don't read, we cannot see any causal evidence here. So therefore, under what condition can funds benefit from disclosure? I will argue that only when investors actually read the letters. Although we cannot track the identities of investors, so here I consider investors' viewing activities of shareholder letters on the SEC Allegor website as a proxy for the readership on the shareholder letters. And so what I see, first of all, unconditionally, the tax refund information is positively associated with fund future performance, which are measured in both short-term and long-term. Short-term is within 3 days, long-term is up to 2 years. And so when we consider under what condition can funds benefit from the flows, and we see that only when the investors read the letters. So informed funds can only attract more capital flows when there exists a greater readership on their shareholder letters. All right, so then lastly, a very interesting finding is that I just want to see what funds tend to send more accurate signals. And so the dependent variable is that the machine learning has same predict correctly with the ex post performance. So here we could see that if a fund has a riskier portfolio, if a smaller funds and more expensive funds, they are actually more likely to predict, to send more accurate signals, so that machine learning can do a better job here. And I think it actually adds unique value because, for riskier funds, their ex-ante, skill probably is, unobserved and uncertain for investors. So therefore, I think machine learning here just adds more value to investors who want to invest in these riskier funds. So for the sake of time, I'm just going to skip some other findings. So in conclusion, in this paper, I explore machine learning to create a text-based skill measure, textual fund information using mutual fund shareholder letters. And I found that textual fund information can predict future abnormal returns as well as Morningstar ratings. And also funds with textual fund information can attract more capital flows in both short-term and long-term, especially when more investors read the shareholder letters. So that will conclude my paper, and I look forward to the discussion.
Great. We are looking forward to the discussion as well. Very cool paper. And Villes from University of Miami is going to discuss.
Okay, thank you very much for inviting me to discuss this paper. I think it's an interesting paper, and let me start by summarizing the findings. So the paper studies the relationship between the textual content of mutual fund shareholder letters and fund performance. And the textual content is first analyzed with a natural language processing model. Alan did a very good job of presenting how this works. And then a neural network algorithm learns about the relationship between the content and fund performance. And the idea here is to test whether the textual content can actually predict the subsequent performance. And the NLP-BERT model, as you said, is really a state-of-the-art model. It's an advanced technique. So this is not one of those bag of words papers where you just take a word list and count how many times a particular word appears. It's actually an advanced method that accounts for the context in which different words appear. And the main findings are that funds defined as informed by the model have more positive alphas, more positive net flows, and are more likely to receive Morningstar upgrades. And more generally, these results demonstrate that the shareholder letters have value relevant information. So just to quickly explain how the methodology works here in detail once again. So the study uses shareholder letters from 2006 to 2014 as the training set, and the 2015 to 2018 letters as the test set. And then the algorithm learns about the relationship between the textual content scores and the fund's future alpha. And funds in the top alpha tercile in the training set are defined as informed funds. So the main indicator used in all the analysis is an indicator for those that are predicted to be in the top tercile. So coming to my comments are mainly about the interpretation of some of the results, and then about some potential additional analysis that could potentially provide more information on this phenomenon. So starting with the measurement of performance here. So the main result is presented in this table here. So you have a regression where you are explaining alpha, and then you have an indicator for these informed funds that are identified as informed based on the algorithm. And the results suggest that the informed funds have an alpha that is 87 to 72 basis points higher than the alpha of other funds. And comparing that to the descriptive statistics in the paper, these are just from table 1, the general descriptive statistics of the sample. The mean alpha seems to be minus 1.45, and the median is minus 1.14. So these are alphas of actively managed mutual funds. And if we add this coefficient to the mean alpha, it would still seem that the average informed fund has a negative alpha. And I realize very well that I may be comparing apples with oranges here. The whole sample descriptive stats may not match the regression sample. But what I'm wondering here is that do the informed funds actually typically have a positive alpha, or is it still the case that they underperform relative to the market? So it might be nice to complement the current analysis with an analysis where you also look at alpha on an absolute basis and not just on relative basis. And I'd be a little careful with the discussion in some parts of the text also. So for example, the abstract states that informed funds identified by the prediction model deliver superior abnormal returns. But it's important to know that the results are based on a relative comparison between funds. So in general, kind of what I'm trying to say here is that a good actively managed mutual fund can still be a bad investment, and might be nice to also look at absolute performance in addition to relative performance. Then one comment about the measurement of performance and fund flows. So currently you measure performance based on the 4-factor alpha, and you control for past performance using the lagged 4-factor alpha. There are a couple of recent very well-known papers by Barber, Huang, and Odin, and Burke and von Binsbergen, where they study what is the asset pricing model that actually that investors actually care about. And it seems that based on mutual fund flows, investors specifically care about the CAPM alpha. So Barber and al. State that investors treat returns attributable to size, value, and momentum essentially as alpha. And there may be reasons for this. So for example, momentum is something that's kind of difficult to obtain as a small investor. You may be willing to pay for funds that are able to deliver those returns. So there's nothing wrong with the current results. What I'm suggesting is that you might want to complement them with analysis where you only use the CAPM alpha as the dependent variable, and also when you control for past performance. And I think controlling for past performance accurately is important also, because that's probably one of the most important factors affecting the content of the shareholder letters. So if you just had a great quarter as a fund manager, you may write a letter basically telling everybody to look how smart you were, or if you were doing badly, you may talk about the general market events or something like that. So I think it's important to get a past performance measure that matches what the investors might typically be looking at. So then this is just a more general comment. Might be nice to understand a little bit more about the drivers behind the performance of these informed funds. So what is driving the alpha in the post period? And you do some very interesting analysis on this already. So you showed us the words that typically appear in the informed funds letters. But what I'm thinking here is sort of, what is the economic mechanism behind the better performance? What kind of strategies are they potentially using when they, after this letter, what kind of information are they using? If you can say anything about that, that could add to the contribution of the paper, and also tell us more about the economic mechanism behind it. So a couple of questions I was wondering about is, for example, how persistent are these informativeness scores of individual funds over time? So do funds have different styles, and does that affect the results? So to what extent are we talking about a cross-sectional effect? To what extent about a time varying effect? And when you add fund fixed effects, the results don't change very significantly. So that would kind of suggest that this is probably a bit more about time varying effects. And I already mentioned the relationship between past performance and informativeness scores, so it might be nice to know how strong the correlation is. And then thinking about thinking about these letters as potential signals, do you think that there is any cost with writing these informed letters? So if you write an informed letter and then you don't deliver the better performance, does the market somehow punish you? Does that affect your net inflows, for example? So if we wanted to think of this as a signaling model, in a traditional signaling model, you would need some kind of cost to get the separating equilibrium, and I was wondering if we have that. So these days we know that artificial intelligence can even generate text. So what I'm thinking is a hypothetical scenario where somebody's just able to generate a letter that looks informed but doesn't deliver the performance, and then what happens afterwards? Is there a penalty? And if there is some cost, then that could explain why we see the better subsequent performance. So could be one potential mechanism. And then I was also thinking about the role of fund managers. So should we think of the effect captured by the algorithm as a fund effect or as a fund manager effect? So for example, are fund manager characteristics correlated with the content of the letter at all? So you probably might be able to get things like experience, and then some demographic characteristics based on the fund manager name. And I don't know if your sample allows this, but if you can observe the same manager in different funds, is the textual content of the letters correlated at all? So does it look like the fund manager take the style with them? Might be nice to know something about that as well. And some smaller comments. This is kind of coming back to my first comment. So defining the positive performance based on terciles is perhaps a little bit broad. And I understand very well that the neural network algorithm imposes limitations on how you can cut the data. But if possible, I would consider some alternative performance measures as well, like something capturing positive alpha, or perhaps top quintile or decile or something like that. One question I was wondering about is also, do informed funds typically have higher fees? So from the previous literature, we know that sometimes when funds have better performance, the fund managers are also able to charge higher fees. And I was wondering if that's the case here. And one comment related to performance. So if it's the case that the average fund in the sample has a significantly negative alpha, you should be able to do better just by holding the market index. So Is it possible that some of these informed funds are essentially closet indexers? So after writing this letter, they just replicate the index, and this should be easy to control for. You could just control for the correlation with the market index. So overall, very interesting paper. Enjoyed reading it. The methodology really seems to be state of the art, and really looks like the paper demonstrates that the mutual fund shareholder letters contain value relevant information. Thank you.
Alan, do you want to take just a minute to respond? You also got some questions from the audience if you tried alternative ways of training the model, not on BERT or other things like that, and how it compared relatively.
Yeah, sure. Just want to, first of all, thank Will for the excellent discussion. I think the discussion is very insightful. And I want to respond to a couple of points, especially the magnitude of the alpha. I think, yes, indeed, the magnitude is not too large. But what I could see is that I have like 4 years of tested data, and in 3 years, I think in 3 years, the informed funds they have positive alpha. So this is what I could see, and also in terms of comment on using like control lag campaign versus lag access return. I think I did that, and the results are still hold. So I choose to just use a lag for factor alpha. But other comments, especially the last several, I think they're really excellent, and some of them. I have been thinking of them, and so I think we'll provide some suggestions that I could do, especially the drivers behind the performance. So this is part that I really like, and I do see that there's a comment from Jie in the audience. So essentially there are like two parts. I know that BERT is initial trained on wiki data. So here, the part that I use BERT is actually just to translate the texture data into numerical form. I still train the data using the shareholder letters, so it can fit in the financial context. Okay, thank you so much.
Great. So it looks like it is my turn to present. Can everybody see my screen? Yes?
Yes.
Okay, cool. So thanks so much. I'm excited. It's AI and high-skilled work, evidence from analysts. This is going to go a little bit different than the other two papers for sort of taking the more bigger picture economics question and saying, okay, we know AI is a really great form of automation. It's doing all of these things, but what are the implications for people who are traditionally tasked with this work? It raises questions about what the future work will look like. And there's been a rich literature on, basically from steam engines to any other major general purpose technology out there. And many people do think, so it was even controversial when they wrote this paper in 2014, but I think now it's sort of very clear that yes, it is a general purpose technology. What will happen? And the key sort of differential is that, high skilled workers, unlike, automation and robots, which generally tend to displace like low skilled workers in manufacturing, this is displacing high skilled workers potentially. And so it leads to a bunch of new questions. I think the quote from Joyce Chang, which I saw that was on the program a little bit, with 80% of the data in the last world created in 2 years, judgment matters more than ever. Technology is a complement to sound judgment knowledge, not a substitute. So that's what we're going after. Is this a complement or a substitute? What happens to the analysts who work there? And we think it's a great context, obviously, because you just have so much data in the financial context. So basically, there's a lot of investors who are using AI to do essentially exactly what analysts used to do. They're using tons of different alt data. And what you need is AI, because I always love these ones. They update it every year so you can see the different pictures. But, all of us streaming Netflix when we first got COVID, this ridiculous number of Microsoft Teams meetings that we're forced to have, amongst other things. And so, there's a lot of data. People can try and use it. Yesterday we were talking about, just how you stage the data and all these other things. There's a lot of interesting discussions. So what do we have? Well, Ronnie, this company actually might be going public soon, which would be really exciting. So TipRanks is one of the people who I think, and this is really what relates to Villet's paper next, they've been working on debiasing data. So they came about in 2008 when the market crashed and all of this stuff happened, and they collect a bunch of different data sources, and they basically have tried to extract signals from these different sources and then all together create a smart score, which is like an AI powered score that goes from essentially 0 to 10. So TipRanks is integrated directly into E-Trade and some of the other platforms. I think they have a contract with NASDAQ. I can't remember all of the people that you now have business with, but you can essentially, just see it when you go there. And these types of signals and everything, as we've probably heard, is used by everybody. Credit card data is the most ubiquitous after web scraping, but web traffic, satellite, all of this stuff. It's a huge alt data industry. Why I'm talking about this in alt data is because I think that's how we're going to measure sort of AI intensity. So what we're going to focus on is this data abundance. AI intensity is basically TipRanks data. Basically, we take the quantity of all the social media data that they have in a given quarter for a given stock, and we look at it. And to put this in perspective, and it's only blown up since then, Apple, Facebook, Tesla just get disproportionate social media attention relative to Starbucks and Coca-Cola. And if you were to go to like sort of a no-name COVID company, it's like 10,000x. Like, it's just ridiculous, or more than that. So we look at 2010 to 2017. We're limited on the upside, not by TipRanks. We're actually limited by the newspaper data. I no longer have access to it. So that's where we are. So what matters? Why would I even be caring about social media? Well, we think it actually has a lot of crowd wisdom. So Jida, who's done a lot of stuff on this, I think Marina and Tony Cookson have a really nice paper on this. Ronnie and I also have a paper that's forthcoming on this. There's just crowd wisdom there, but it's really hard to locate. So you have to have the AI to locate it. Even if the analysts don't care about the crowd wisdom and they're busy doing other stuff with their jobs, they're going to feel the pressure. Where are they going to feel the pressure? Well, they're going to feel it because their job is to come up with like a unique trading strategy or a unique angle on the stock. So we developed testable hypotheses. You have to think about it as this, we're looking at AI as a labor augmenting technology, but obviously, it's not going to increase the demand for all tasks. And so if you just go back to your basic supply and demand, there's going to be more demand for maybe different skills like social skills, and maybe less demand for the previous sort of quant skills. So that's the sort of task-based framework. And the hypothesis we get then are substitutes. Are analysts switching careers? Are they switching coverage from high to low AI stocks? Complementary tasks, does it free up their time? Do they get to focus on their competitive advantage, which I think of as soft information or social skills? Product quality. This is where we then look at forecasts and say, what happens to their forecast? Do we see it? Maybe is it an effort channel or a strategic channel? A little bit hard to disentangle. And then finally, compensation. We're able to look at that a bit. So we look at a bunch of different levels: an analyst level, an analyst stock level, and a stock level. If you were to just think about it randomly, assume like, I cover the car industry, Ford gets a lot of attention and Tesla gets a lot of attention, but the other stocks don't. There is some little bit of a sense that social media is a bit random with respect to what analysts do. That being said, typical analyst covers 10 to 15 stocks in their portfolio. And so what we're going to say is if more than a quarter of your portfolio is these high AI stocks, like, that's representative of high AI intensity. It's not sensitive to the threshold. I've done a ton of robustness checks there, so I wouldn't worry about that part. So what do we do to sort of move around? Because you don't have exogenous variation. I think the OLS is reasonable, but we're at a different standard in the literature. How do we move it around? We move it around with news. So if you have a short headline, and this is true both online and in the print edition, advertisement sales basically determine the headline length that you see. Okay, if they sell, more advertisements, some advertisements are big, we have to shorten the headline. Okay, and that ultimately, sometimes people see a short headline, and they start to decide to tweet. I know this. I have a limited attention span. I like short headlines. I tweet about that. Okay. It's quasi-random, and so that's where we're getting this incremental change in social media to try and identify it. So just to show you that there is seemingly random variation, this was all from the week when Wells Fargo first found out about the scandal. So Wells Fargo is getting heat, Wells Fargo fined for a sales scam. These are short headlines. You can go up to these super long ones that I still don't even want to read right now. But newspapers did this. This was like the Washington Post. These are important newspapers. Okay. So other things to think about, because it's an instrument and everybody always loves to pick on instrument selection bias. Do editors have this massive bias in them that they just, they have something, in their trading strategy, they're commonly owned or something like that. I just saw that newspaper and I also write on the common ownership literature, so that cracked me up. But what do we see? We do not see selection bias. We also do not see evidence for other sort of types of concerns. So we look at key events like earnings announcements and other things like that. We see no evidence that you get different headlines when you have an earnings announcement. So this leads us to think that our instrument is probably okay. And this is where we get to our findings. So substitution, yes, we see career switching, especially among top talent. They leave, and where are they going? They're actually going to non-research roles. I think that's actually the coolest part to me. They're going to these, and if you look at, we do it by a bunch of different careers, but they're really going to these investor relations roles. And I've had people now reach out to me. I gave one for our Fuqua alums. I did a thing and I've had several reach out to me and tell me yes. So I do think that this is definitely happening. And stock coverage also is just moving away from the high AI stock. So it's not just this extensive margin that people are leaving the profession. And we certainly do comparisons to pre-periods, like so early 2000s, it's definitely higher. But we also see that they're just not covering those stocks anymore. They're like, fine, I don't need the 37th analyst on Facebook. Let me go cover some other unknown name. Okay. And so this is sort of like a nice part of the literature. I think it complements that literature out there. This is where we sort of, I think it's fun. We brought in soft skills. I write a lot on culture, so I care about soft skills, obviously. I want life to be a bunch of happiness and engagement and a lot of fun. And so I wanted to look there. And what did we go after? So we went after the transcripts from the earnings calls, and we found that they're asking questions not about profits, sales, or price anymore, but they're asking questions about complex ideas. They're asking about intangibles, engagement, culture, those exact things that I like is what they're asking questions about. So they're shifting the content to those things that are harder to measure that you can't measure with AI, essentially. It's still impossible to measure most intangibles. They're also more questions are being asked, which I thought was rather interesting. And the questions that are being asked are longer, so suggesting, again, complex ideas. We look at the product quality. So this is when we're just sort of looking at sort of the classics in the literature, the bias, the forecast errors, and the boldness of your forecast. We see that we see it more for accuracy. So we do see they're getting more accurate. A little bit for bias, less bias. I mean, they're sort of related measures. We see they're making bolder forecasts, but that you can't say if that's effort or if that's actually strategic response. And what I would say, though, is this masks a lot of heterogeneity. So I think this is a key thing for people doing machine learning, because I'm actually working on an AI project in management right now. There's people in the upper quartile of productivity or skill or talent respond very differently to AI than people in the bottom quartile versus people in the middle 50%. Okay, and so thinking about that, we run the quantile regressions. I've thought about it. It is definitely the case that it is not consistent across. It's just a very small set of people who seem to be very pushed by this. But this is clearly, as people who run regressions all day, we know this is going to affect your treatment on average. Okay, and so understanding that seems to be important. But overall, consensus forecast improves, which is a good thing. So AI is good even for analysts. But not necessarily. This is the sad looking analyst at home when he got his bonus number for the year. Earnings data is unavailable for analysts, but we do know their incentive pay is linked to excess trading. That's a large component of their pay. And higher AI intensity is associated with lower excess trading now. This is both in terms of volume and returns, which suggests they're getting lower pay. I've done a lot of robustness on this. It's not necessarily all in the paper, but I've looked at sort of, followed the same analyst pre and post periods to try and understand this in innovation. And that's sort of where we get. Ronnie and I are cleaning up some things. We're adding new data, different alt data sources to this. I've went down the path of just doing a lot more. I think it's cool. I love seeing what the analysts are doing. And, so in that sense, I love all work on this. I think it's a cool question. We're going back to trying to understand the economics of it and what are the implications in the broader set for any incumbent worker tasked with AI like work. I think sell-side analysts are exactly a great setting to understand this big economic question, even though it's very nuanced in a particular person. And what we're seeing is even here, they're focusing more on their soft skills advantages, their analytic advantage declines. And so they're also, some of the talented ones are leaving and changing careers. And ultimately this talent change is going to affect the overall product quality. We may be in a short-term equilibrium where it improves, but you never know in the long run. Okay, so thank you. And now I forget Alan's discussing my paper. Yes. Okay, cool.
Yes, sure. Let me share my screen again. Okay. Okay, so you can see my slides, right? Mm-hmm. Okay, great. So you actually left me like 15 minutes, but I probably will not use 15 minutes because I do like this paper a lot. This is actually not the first time that I see this paper presented, because I think Jill presented at Georgia State, where I am right now, like a couple months ago. I think it's a great paper. So, Jill just did a very excellent presentation on the findings. So I'm just going to use one slide to summarize the findings. So first of all, it's a very exciting data set on the variation in the AI's power across stocks, and very important research questions. Does AI substitute or complement high-skill work, and what are the implications for analysts? For the substituting effects, the answer from the authors is yes. Analysts, they reduce coverage on high AI intensity stocks, and also high-skilled analysts create a profession. For the complementary effect, the answer is also yes. The analysts, they shift to their soft skills. They try to arrange more meetings with management as well as institutional investors. They also raise more complicated questions during the conference calls. And there are also important and interesting implications. So we find that the quality, not we find it, but the authors find the quality of the analysts' work improves significantly. But on the other hand, the analysts are compensated less. So probably it's not good news for them when they face the AI competition. So I think this paper has a lot of contributions. First of all, it brings up the tension between AI and the future of high-skill work. And I think from the findings, one thing that we see is that now high-skill work and AI, it seems that they are using their comparative advantages, as AI use the hard skill, while the human talents use the soft skills. And I think the also very important contribution is a IV port. It's a very novel IV using the USA total headline lens to establish the causal effects. I think it's super clever and convincing. If you read the paper thoroughly, you'll find that there are tons of tests to show that this IV satisfies the exclusion and relevance rules. So I don't have any comment on the IV. I think it's just brilliant. But I do believe that this paper also calls questions on the equilibrium between AI and human talents. So it brings more attention to this field, as I think the tension between AI and the future of high-skilled work will continue to be more important. So I have just several comments on the paper. So first, when I read this paper, especially when I go to the variable construction about how they define the high AI intensity stocks. So the first question that came up into my mind is that, well, probably the high AI intensity just capture the popularity of the stocks. So are they really AI intensive stocks or more popular stocks? So we know that this variable high AI intensity is defined as the top quartile of the number of social media posts, and we also know that the number of social media posts would reflect the popularity. So, and if I'm a analyst, and I know that so many people are crazy for Elon Musk and they are going to buy Tesla, so probably I'm not going to spend my time on analyzing Tesla, because even if I say that you should short sell Tesla, you should sell Tesla, this investor probably won't listen to me. So the value for a human analyst probably is not too much. And at the same time, I think an in-place assumption is that AI is probably better than human in processing big data. And so that's why when there are more data available for some stocks, the analysts, they shift or they quit. But on the other hand, the social media posts can be noisy or misleading or even fake. So in that sense, we still need the human ability to extract the most useful information out of the sheer volume of the data, like social media posts. So here, and I know the authors already have several alternative measures. So I would say, like, I think the current measure is fine, but I think I would be more convinced if the high AI intensity stocks are also those that AI has more accurate predictions. So AI is doing better job for these stocks. So I think an easy task to show is just to show that high AI intensity is positively correlated with the accuracy of prediction by AI. I think there are like other potential fix to support this kind of argument, but I think this is definitely one of the easiest way to do it. And my second comment is related to the findings in the paper. That's the authors found that human talents run away from the high AI intensity stocks, and they even leave the profession. So I'm just thinking, from the social welfare point of view, are investors, who use these recommendations, are they better off? And I think the first hypothesis would be that, well, the analysts just reduce coverage for all high AI intensity stocks. So therefore, we don't know whether people who use the recommendations, whether they get better prediction from AI, and because now these high accurate analysts are replaced. But then another hypothesis is that there could be a variation in the AI prediction accuracy especially across the high AI intensity stocks. So if analysts are just more likely to stay away from the stocks for which AI can do a better job, so maybe for investors they are better off, because for some stocks, they're for example, the social media posts are pretty noisy, so we still need some human analysts to get the useful information. But for some stocks, maybe we could just rely on AI, and we could get all the useful recommendations. So related to this point, I think the goal of this paper can actually be more ambitious, because I think it is not only AI, but also overwhelming data that create the hurdles for human. Because if you guys recall, I think one picture that Gio just showed us, that's the kind of data used by institutional investors. I think the web data is just very large, and I believe it's web data just increasing. So we have so many data, and we know that human has limited capacity in processing information, while machine does not. Right? So therefore, I'm just curious to see, what's the equilibrium of task allocation between machine and human, because maybe it's not because disruptive AI causes the competition. It's just because now we face too many data, so we have to advance and develop AI so we can better understand the data, and also because human just has limited capacity, so we need AI. And so I also have two other just minor comments, I believe. So the first one is that I was just curious to see what new analysts do, and so do they begin their career by focusing only on low AI intensive stocks when they begin their career? I think it will be different as they enter the career and they start to realize that there's a competition from AI, so then they shift. I think the second case would be a little bit inefficient for them. So therefore, if the new analysts, they begin their career by only looking at the low AI intensive stocks and combining with the finding in the paper that analysts are more likely to use their soft skills, I think it would suggest a trend of efficient allocation of talents in this industry or even across industry. Because if I'm a new analyst and I know that I'm good at my soft skills, I would enter this analyst profession. If I'm not good at my soft skills, I would go to another industry. Right? So I think this is probably something I'm just curious to see. And also have a comment on the quarterly level analysis, especially on the analyst quit probability. So I think results are a little bit astonishing to me, because my interpretation on the quarterly level analysis is that it seems that analysts leave very soon. I recall that these analysts, they are the analysts who have pretty accurate prediction and forecast. So in other words, from regression, what we could tell is that there's a shock from AI in quarter T, and then next quarter we see that it live. It seems to me that they just live too quickly. So I'm just curious to see what's a time series variation in the AI intensities. I think that will better help us to understand the specific relation. And also I'm curious to see whether there's like dynamic in the analyst actions. So I would think that with the increasing AI intensity in the first quarter, first we observe that analysts, they reduce the coverage, and probably they also shift to the soft skills in the second quarter. And eventually, after a couple of quarters, they leave the profession because they don't want to compete with AI. I think that would be like a more smooth transition for their decision making. So overall, I think I really like the paper, and I just recommend everyone to read. And I commend the authors for a very, very impressive set of analyses and the use of very novel data sets. I think the authors established many interesting and ultimately very important findings to help us understand the impact of AI on financial industry. And the paper also offers intriguing implications to the analysts and potential also to the policymakers. So eventually I want to answer a question: how do we deal with disruptive AI? And I think this question will become just more important as the size and the scopes of the data continue to increase in nowadays. Okay. Thank you.
Great, thank you for the thoughtful discussion. So the timing one about the analyst quitting, and I've aggregated it different ways at the year level. If that's like a preferable one, you twist off that way. It still goes through. I could do the little map of it going out in quarters. So I don't think it's particularly sensitive there. Somebody asked about popularity, or you might have brought up the whole popularity, or maybe that was a question in the audience. So for sure, we're putting in all these controls for other variables. So we're putting in controls for like, what is actually going on in the news. Is this like, a newsworthy stock this quarter? Is this a stock that has, what's the firm size, all of those things. So we put a lot of, standard volatility, liquidity, that type of control to try and make sure it's not sort of stock characteristics. That being said, one other thing I was trying to think about, you made me think about a lot of things. So a lot of what he's saying is the direction. I'm excited. I was teaching new classes online, and I finally actually just finished teaching my MBA class recently. So life will be good. I can get back to actually finishing this paper, which will be awesome. But what we're trying to go and where the direction is is to try and compare it versus these different measures. So you were just talking about the SEC downloads. Yes, I just have done that myself. We're going to go there and see how popular it is, SEC downloads versus that versus other measures. And the other thing that came to me for anybody else who's working in this space, I had the brilliant insight. I was reading through some of these analyst reports, and I saw a source under the figure. And I realized that they sometimes, occasionally, not all of them, most of them, they will say, and they will reference, UBS, their machine learning or machine intelligence group, or they'll reference actually a fintech firm. So that gives me an ex post realization of if they're actually using this sort of AI on their job. I think that's sort of the problem with this area, is that I've already done a lot, and there's still, because all of us love data or love machine learning, always ask for more. So be a kind referee to the rest of us out there who don't want to go get a bazillion more data sets. But with that, I'm very excited. I think it's a cool area. And I'm clearly obviously working on some more stuff here too, but I'm very excited to see debiasing data, because that is exactly the paper Ronnie and I have been wanting to go after next. So with that, I think unless anybody else has any questions, I will have Vile present his work on aggregated analyst forecast. Okay, cool.
Thank you very much. Yep. So this is joint work with, let me see if I can get this. Control L doesn't seem to work, so yeah. So this is joint work with Vidhi Chowcharya, Alok Kumar, and Swati Murali. We're all at the University of Miami, and Swati is our PhD student. She's only on her first year and doing work on machine learning, so you may want to keep an eye out for her. So in this paper, we develop a neural network algorithm that learns about the predictable biases in individual analysts' earnings forecasts. And it's well known that analysts' earnings forecasts have a predictable component. It's been documented in the literature. There are a number of potential explanations for that. And our idea in this paper is to train a machine learning algorithm to learn about the biases in individual analysts' earnings forecasts. So we first try to learn about the biases, predictable biases in individual forecasts. Then we debias the forecast, form a new consensus forecast based on them, and we find that our debiased consensus forecast outperforms linear benchmark models in predicting earnings surprises. We also develop a trading strategy, or sorry, a portfolio strategy, not really a tradable strategy, that shows that the predicted earnings surprises are correlated with abnormal returns during the months following the earnings announcement. So overall, this is a very early stage paper. This is the first time we are presenting it anywhere. It's still partially incomplete. We wanted to get this done for this conference, and we're very much looking forward to the comments. So as I mentioned, analyst earnings forecasts are known to have a predictable component. It's very well known that analysts' forecast errors on the same firm are autocorrelated. So statistically speaking, it looks like analysts are not learning from their own past mistakes. And there are a number of potential explanations for this. So many papers have explained this with strategic behavior. Analysts may try to strategically position their forecast relative to other analyst forecasts. They may want to show optimism or pessimism. Some papers suggest that when they optimize their forecast, they don't just care about forecast accuracy. So they may engage in skewness related optimization, where they try to take into account the distribution of earnings surprises. There may be uncertainty about the earnings process, and there are also papers arguing that the market values forecast consistency, so it may be good for their careers if they are consistent in their earnings forecasts across quarters. And in addition to that, there are also behavioral papers. So it's well known that analysts too suffer from behavioral biases. They have limited data processing capacity, and that can also contribute to predictable forecast errors. So we take this as our starting point, and our idea is that we know that analysts have predictable biases, and we should be able to train a machine learning algorithm to learn about these biases. So it's very difficult to capture all of them in a linear model. The effect of these biases varies across analysts. It's not clear what exactly we should be looking for, and the benefit of machine learning is that we can let the algorithm learn about what is relevant here. So our approach is that we first try to learn about the biases in individual forecasts, and our conjecture is that it should be possible to obtain a more accurate consensus forecast by using these debiased forecasts. So this is our approach, and overall this is a very nice laboratory for machine learning, because we usually have a long history of earnings forecasts made for the same firm by the same analysts. We have a number of analysts covering the same firm, so there's a lot of repetitive comparable training data that we can use for our algorithm. So previous studies predicting forecast errors and earnings surprises can roughly be divided into two categories. There are panel models and analyst-specific models. The studies typically have a slightly different focus here, but the panel models focus on predicting the earnings surprise with firm characteristics. An example of this kind of paper is Eric So's 2013 JFE paper. And then we have analyst-level papers that try to predict analyst forecast errors with analyst characteristics, previous forecast errors, and other variables like that. So in our paper, we use both these approaches. Our main model is an analyst-wise model that only uses information on the analyst's past forecast errors and other forecast and analyst portfolio related characteristics. That model doesn't use any information whatsoever on the firm itself. Then we also have another neural network model that's a panel model and uses firm characteristics, and that kind of serves as a benchmark, but more generally the comparison between these models can also tell us something about what kind of information should we be using if we want to improve earnings forecasts. So there is this philosophical question: if you want to improve the earnings forecasts, to what extent should you be focusing on the firm? To what extent should you be focusing on the forecasters? And that's something that we also try to compare here. In addition to these two neural network models, we have an analyst-wise neural network model and a panel neural network model. In addition to these models, we also estimate benchmark linear models that use the same data. These are just based on linear regression, use the same explanatory variables, and they provide us with a benchmark. The idea is to test whether we can do better with a neural network model. If this was just about some very naive autocorrelation, then that should be something that we can already capture in a linear model. We shouldn't see any improvement when we use a neural network model. So our neural network models are boosted regression tree models. These have recently become very popular in finance, and the models provide a relative importance weighting to each independent variable, and they allow nonlinearity. So the nice thing here is that we don't have to define the relative importance of different variables ourselves. The panel models use firm characteristics from Eric So's 2013 JFE paper. So we just took a variable list from one well-known paper for the firm characteristics. And the analyst-wise models use various forecast and analyst characteristics. However, only 5 variables turn out to have relative influence higher than 1% in our model. So those 5 variables are 4 lags of forecast errors. So we take 4 lagged forecast errors on the same firm, and then the forecast horizon. Forecast horizon is the time difference between the date of the forecast and the earnings announcement date. And there are already some previous studies that show that forecast horizon is related to forecast accuracy. And the benchmark linear models use the variables that have a relative influence higher than 1% in these BRT models. So we are essentially using the same set of explanatory variables. And in the analyst-wise estimation, we estimate a separate model for each analyst. And in the panel estimation, the estimation kind of implicitly assumes that there is one representative analyst. We have checked that our results are consistent in out-of-sample estimation. So we've also done an estimation where we define the out-of-sample period ourselves. The results remain consistent. The relative performance between models remains similar. So we're quite confident that we are not suffering from an overfitting problem. We've also experimented with different number of trees in the model, and the results remain consistent. So the way our estimation here works is that we first try to debias individual forecasts using the 4 models that we have. So the 4 models are our analyst-wise neural network model, our analyst-wise panel model, and then the linear benchmark models for both models. We first debias individual forecasts. Then we take the predicted forecast errors from these individual models. We calculate new debiased forecasts so that we take the forecast from IBES, adjust it with the predicted forecast error. And finally, based on that, we form a new consensus forecast and then test whether we are able to improve our earnings forecast based on that. So the data is very standard. We use Analyst quarterly earnings forecast from IBES. The sample covers 1984 to 2019. We also use stock price data from CRISP and firm characteristics from Compustat. The variable definitions are very standard in the literature. So we use the last forecast issued by the analyst before each earnings announcement. And the forecast error is defined as the analyst forecast minus the announced earnings scaled by share price. This is standard in the literature. You want to scale by share price because these are EPS figures. So coming to our results, let's first look at the model's ability to predict the sign of the forecast errors. So here we have our 4 models. We have the panel linear model, the panel neural network model, then the analyst-wise linear model, and analyst-wise neural network model. And column 1 shows the ability to predict the sign of the forecast error in individual forecasts, and then column 2 in these debiased consensus forecasts that we formed based on these individual predicted forecast errors. And these numbers here are percentages, so we're essentially predicting, are we able to predict the sign correctly, whether it's going to be positive or negative. And starting with the panel linear model, the panel linear model really has no predictive ability whatsoever. So you should get 50% just by chance. And here, the panel linear model is able to predict the sign correctly 51% of the time with individual forecasts and 46% of the time with consensus forecasts. The panel neural network model already has some ability with individual forecasts. The sign is correct 59% of the time, with consensus forecast 55% of the time. The analyst-wise linear model gets the sign correct 54% of the time, and by far the best performing model is the analyst-wise neural network model. It predicts the sign correctly 64% of the time with individual forecasts and 68% of the time with consensus forecast. And it's also notable that there is some improvement when we move from individual forecast to consensus forecast, implying that aggregation of data may add some value here. So next we are going to look at how well or how close these models get to the actual forecast error. So we're first going to look at individual forecasts, and on the next slide we're going to look at consensus forecasts. And our metric here is the absolute deviation from the actual forecast error. So what we calculate is the difference between our predicted forecast error and the actual forecast error, and then we take the absolute value. The lower the value, the closer you are to the actual forecast. So the lower the value, the more accurate the model is. And here are statistics based on our 4 models. The best performing model is the analyst-wise neural network model. With the analyst-wise neural network model, the mean deviation is 0.318. With the linear benchmark model, the mean is 0.332. The difference in medians is slightly higher. So here, the analyst-wise neural network model performs the best, but the difference, the relative improvement, is perhaps not that economically significant. So we get a 4% lower mean absolute deviation compared to the benchmark linear analyst-wise model. So these are individual forecasts. But next, we are going to move to consensus forecasts, and there the relative performance difference between the models becomes bigger. So here are results, similar results based on the predicted consensus forecast errors. And the analyst-wise neural network model, again, performs the best. And now the difference relative to other models is bigger. So the analyst-wise neural network model has 24% lower mean absolute deviation compared to the linear benchmark model. So the mean is 0.295. And we've also checked that we do get an economically meaningful improvement relative to the actual forecast error in IBES. So if we compare the absolute forecast error of the actual forecast in IBES and then our neural network-based consensus forecast, the median improvement is about 12%. So we're talking about something economically meaningful. Okay, so the results so far suggest that we are able to predict the forecast error better with our model. But then a natural follow-up question to ask, of course, is that is this still capturing some information that is, or is it possible that this is actually capturing information that is already built into stock prices? So if analysts have predictable errors, perhaps the market is already aware of it, and this predicted component of the earnings surprise doesn't really have any market implications. And to test that, we use a portfolio strategy. So we take our neural network predicted earnings surprises based on our analyst-wise neural network model. And we sort stocks into 10 decile portfolios based on their predicted earnings surprise. So we take all the stocks with an earnings announcement coming up next month. We calculate the predicted earnings surprise for each of them based on our debiased consensus earnings forecast. And then we allocate them into these 10 portfolios. We keep the stocks in the portfolio for 3 months or until the month before their next earnings announcement, whichever is less. So the reason we have this 3-month holding period is that we want to make sure that we have roughly the same number of stocks in each calendar month. And it's also motivated by the previous findings on the earnings announcement drift. So we have these 10 decile portfolios, and then our long-short portfolio invests in the stocks with the most positive predicted earnings surprises and shorts the stocks with the most negative predicted earnings surprises. So here are the returns on the 10 portfolios. These go from 1 to 10. Portfolio 1 has the most negative predicted earnings surprises. Portfolio 10 has the most positive predicted earnings surprises. And these are mean monthly returns, average monthly returns on value-weighted portfolios. And what you can see is that we do get an increasing pattern from portfolio 1 to portfolio 10. The mean return in portfolio 1 is only 0.6%. In portfolio 10, it's 1.11%. And the long-short portfolio, the 10-1 portfolio, earns a return of 0.5% per month. It is statistically significant. So one thing I want to emphasize here is that these are all in-sample results. We are not presenting this as a tradable strategy right now. The idea is just to capture if we're actually capturing. It's just to test whether we're actually capturing value-relevant information here. We plan to test an out-of-sample strategy eventually as well. We haven't had time to go there yet. We've also checked that the performance persists after controlling for other risk factors. So in a 3-factor model, we get a statistically significant alpha of 0.5%. And here I have the long-short model on the left, and then the short and long portfolios on the right. So the effect also survives in a 3-factor model. So this is where we are now. As I mentioned in the beginning, this is still an early stage paper, very much work in progress and partially incomplete. So we plan to add more economics to the paper as well going forward. So right now the paper perhaps reads a little bit like a technical note, but there are a number of potential interesting applications for this methodology, also besides improving earnings forecasts. So what else could you do with these neural network predicted forecast errors besides improving the forecast itself? Well, one interesting application is, for example, that this model provides us some kind of benchmark on the time varying predicted biases of individual analysts. So we know that analyst forecast accuracy varies over time, varies across firms, and usually it's quite difficult to say to what extent this variation is due to biases, to what extent it's due to variation in information environment. And here we at least have some kind of benchmark on what the predictable component of the forecast error is over time. The predictable errors also allow us to classify individual analysts based on their forecasting style or accuracy. So our early results, something we don't have in the paper currently, suggest that there is variation in how predictable the forecast errors are across analysts. Some analysts have more predictable forecast errors than others. Some have predictably positive forecast errors, some have predictably negative forecast errors. And if we, for example, regress our predicted forecast errors on actual forecast errors, there is variation in R-squared values across analysts. And it might be interesting to look at how this is correlated with analyst characteristics, for example. And the data aggregation might also offer interesting applications in the future. So right now we are using a relatively naive data aggregation method. We form the consensus forecast exactly as it is defined in the literature. So we just use the median, but there might be other ways to aggregate the data to predict the earnings surprise even more accurately. And also might be interesting to aggregate data at the stock level, potentially even at the industry level, based on how much these predicted forecast errors vary across analysts. So sometimes you have firms where all analysts have predictably positive forecast errors. Sometimes you have firms where some analysts have predictably positive, some analysts have predictably negative forecast errors, and then looking at how that's related, for example, to the post-earnings announcement drift might be one potentially interesting application. So these are things we haven't had time to look at yet. So in conclusion, we develop a method for improving earnings forecasts based on analysts' neural network predicted forecast errors, and it appears that the method outperforms linear models in predicting analyst forecast errors. And our results suggest that individual errors are more predictable and can be corrected more effectively than the aggregate consensus forecast. And more generally, one potential take out of these findings is that if we want to improve forecasts, perhaps we can learn more by looking at the forecasters than looking at the firms themselves. And there are many settings in finance where we have professionals doing forecasts, and sometimes if you want to improve the forecast, you might do a better job if you focus on the forecasters instead of focusing on the inputs of the forecast. Thank you. We are very much looking forward to comments.
Cool. So, oh wait, oh, 1 second. Let me share my screen. View full screen. Great. So I was very excited about this paper, and I'm going to sort of try and put it in perspective and think a little bit about how maybe I'd frame the paper. So I think there's a lot of factors helping AI to progress in finance, and if we really want to get into the nitty-gritty and divide them up, it actually is sort of useful for thinking through the economics. So we have data abundance, and I think that's sort of what I was talking about, the satellite images, parking lots, whatever. You have computing power. Clearly, data processing is less costly. I think the guys at AI, they had a thing about how we broke Moore's law basically with AI. It was a very pretty graph. I've put it up sometimes before, but I didn't put it in this presentation. But obviously computing power is helping. Algorithmic improvements are helping, especially for, sort of stable results. I think that's actually a very nice thing and that people talked about. But what I think this paper is getting at is this data quality and this debiasing of data. And I think even yesterday they were talking about, I really loved the redheaded guy from NASDAQ, his talk, but how, we're this data quality, we're enhancing it basically because we've streamlined this process. We now know how to figure out what is garbage, whereas it's been a lot harder to figure out in the past what's garbage because we have so many more data sets. We're basically, everybody is now IBM. So I used to work as a consultant. IBM was one of our clients, and they used to blue wash all their code whenever they bought a new firm or whatever, and they love to buy everybody every year. But that was one of their processes. This is essentially what AI has done for finance now. And so I think this debiasing of data is very cool. Like in some sense, it's what TipRanks is actually trying to do. They're trying to debias the analyst forecast, but there's other contexts. So Ronnie and I's fintech paper, although they were the smallest component, they were actually the ones that I found quite frankly the most interesting, was the ones that were trying to do this. And so I think, just as anybody who might be a PhD student or anything else out there, this is a great area to go after, okay? And so what they do in this paper is then focus on, he was very clear about it, what we're gonna do is quantify the error in individual analyst forecasts, and then it's an incredibly important variable is consensus forecast, okay? So what do we get from the neural net? I would say this is just a general comment. I knew it was an early paper, so I'm not going to clean up the language, because sometimes you say it's like a multi-layer one, and then later on, I think when I was reading the details more clearly, it is a single layer with like 15 basically different neurons. But I would say there's some inconsistencies in the paper, so that's just for you. But what they're doing is basically saying, okay, we're inputting all this data, and we run it through basically a bunch of different neurons that are sort of intermediary steps that you think about it, and then ultimately we're going to get this output. We're doing this at the individual analyst level, which is really cool. They also do it on this like alternative one if we were going to do the Eric So's method, but Eric So's stuff doesn't seem to work out here. That's fine, because I like the analyst stuff better. I'm happy with that result. Okay, so what do the authors find? This analyst versus panel, the first one. So analyst-wise models outperform panel models, and the analyst-wise neural network model outperforms the linear one. The neural network mean reduces deviation by 4% relative to the linear model. So I did sort of want to know what the economic magnitude. I thought he did a much better job in cleaning it up in his presentation. So thank you for doing that. So the new Y variable, that's where they get to. They created, a debiased consensus. I think that's really cool. And it's sort of in some sense, remember the discussion from yesterday when he was talking, which I found very interesting, about, really, where do you want to use alt data? You want to do it to get something that may come at sporadic times, and you don't know when you're getting the, oil update report. You're getting it once a week. Can we get something in real time that does that better? In some sense, what he's saying is if we can debias it, we can get something in real time. I think that's actually a very cool point that it might be worth like linking to. And so ultimately, this gives us this timing benefit, and it outperforms. You can predict these earnings surprises, and then the portfolio sort suggests that it didn't get included, especially for the stocks you would short. Okay. And I would push you to try and see if you can get the trading strategy, because I know people tend to like that, and we always got pushed that way. But no big deal if you don't. Okay. The economics of a debiased consensus. So this is what I really want to think about in a much broader sense. Because I think this is where the literature is contributing. At the end of the day, we're financial economists. We're not just data scientists. Okay, so do investors care about analyst accuracy? So this is pulled from the Institutional Investor magazine and whatever. I was shocked. It's actually earnings estimate is number 11. It's not actually what they really care about. They care about more of these social skills that I was suggesting, and this is even from an older magazine. Okay, so this notion of accuracy, maybe it's just us that we like accuracy. Well, maybe it's just that they already knew that they're not really accurate, as he was suggesting. And this is, I have always liked this Owen Lamont paper. I know you put up some other citations. I think it's very nice because he and he was looking at macro forecasters, but this idea that they're going to respond to other factors out there, and there's this feedback effect, is very nicely put in here. So forecasters may use their forecasts in order to manipulate beliefs about their ability. And this is what I think is to be the case. It's not just, strategic and these agency models that are static. It is about this manipulation over time and this dynamic sense. Okay. And so as forecasters become older, more established, they produce more radical forecasts. They become less accurate. Okay. These findings are consistent with reputational factors. All right. So we know that. Okay, I also went and just searched to see what's been done. I was surprised that people hadn't done this. I did find one paper where somebody had been doing exactly some of the models you'd been doing, unable to beat analyst predictions, the model was trained from 2013 to 2016, 2017 to 2019. So this makes me think it's something about you have a super long training period, more data, something there. And this sort of relates to your question from the audience. So what's the mechanics behind the authors, what they're doing? They're just using the last one before consensus, okay? There's a lot of information in their updates. And they're training on basically pre-2010. It was unclear when it started, but I'm assuming you know, IBIS goes back pretty far, so you got a lot of data. And then they're doing it post-2010. So thinking about this back to the big picture. With deep bias consensus, you know, what would that actually do? If that was what I saw when I went up each day and knew that me putting my number in is not going to just be taking the median anymore, is there going to still be this lure to the consensus that they talk about? Or would they maybe want to be strategic and make these bolder forecasts, and so that the attention goes away? Okay, this tension of lure versus bold suggests actually in the long run, what would matter is actually the first forecast, because you'd have an unraveling effect. You'd go back to the beginning. Of course, this has issues too, given, you know, the horizon of forecasts. Typically, they improve over time. So this then suggests to me, you know, you can't just run it on first forecast. You might be able to put learning in there some way, but, you know, an intelligent discussion of these types of feedback effects and a recognition that these feedback effects mean introducing such measures would move us out of an equilibrium, I think would be really, really help link the literature together and help people say, okay, they're not just giving me a novel tool, they're helping me understand the economic insights. Because in general, you know, one of the things that I think a lot of people complain about AI is that it's not stable. Like you have a small perturbation and what you're going to have is basically it goes berserk with the prediction. Okay, well, now we've just trained it on all of these analysts, and you know they know that the thing is going to get changed, and so they're going to react. And how is that going to make it go berserk? Probably not, but you know this is important to sort of understand. Okay, since there's a large literature on the real effects, this would be the other thing I would go after. You know, there's a large literature about meeting earnings expectations. Can you add an implication section to discuss how these deep bias consensus, which I'm really excited about, you know, how they might lead to more informative prices, or how they might lead to better allocative efficiency, both on a corporate side or from just the perspective that prices are better. You know, I think that's something that would be really helpful. I think sort of this also linking to this literature, you know, if you compare it to analyst forecasts for sales or discount rates, I think Joe Pacelli has a nice paper where he's looked at sales and a bunch of different stuff. My guess is because we're not anchored on it, and this is just my intuition, but I think helping us distinguish this factor of how important it is because earnings is what most people have anchored on so much historically versus if you could get sales better, or if you could get all these components together, and how that might play into price efficiency, I think is a really sort of helpful discussion to have. And so, you know, I am a big fan of the debiasing literature. I think it's great that you're putting it out there. This is a frontier AI and finance topic. I would love to see more work on it. You know, and when there's something frontier, I think it's really important to relate it to other literatures to make it clear, especially about the implications given theory. So ultimately, hopefully this helps you with bigger questions about everything. But, you know, and I thank you. I thought it was a great to read and to learn and to think about, and I look forward to future drafts because it was definitely an early version. Okay. I think you had some questions in the audience, so I will stop my share and open it up to audience members.